I'll be discussing now the topic pertaining to absorption and variable costing. Okay, so first, what is absorption and variable costing? So first, I need to give you an overview of what are the two product costing methods that are available. Okay, so first we have what we call your variable costing. So your variable costing is a costing method that includes only the variable manufacturing cost, which includes your direct materials, your direct labor, and your variable overhead in the cost of a unit of product. Please take note that under variable costing method, no, the fixed factory overhead or fixed overhead is treated as a period cost. Okay? Do you remember our cost concepts pertaining to the product and period cost? So in here, no, in variable costing, again, the fixed overhead is treated as your period cost. Whereas, 'di ba, we have a discussion that overhead should be part of your product cost, no? That is under what we call your absorption costing. The discussion that we have in the previous weeks, the assumption there is that the fixed overhead is treated as part of your product cost. Okay. In variable costing, it is now treated as your period cost. Okay. Now we go to the absorption costing. Your absorption costing, or what we call your full costing, it includes all the manufacturing costs, which includes your direct material, direct labor, and both the variable and fixed overhead cost. Okay? Under this costing method, again, your fixed overhead is treated as a product cost, as I've mentioned earlier. Okay? Again, in the variable costing, your fixed overhead cost is treated as period cost, whereas in your absorption costing, it is treated as part of your product cost. Okay. For the absorption costing, I would like also to highlight here that this costing is, the absorption costing is required by GAAP for external reporting purposes, no? I mean the US GAAP, and also with the PFRS or Philippine Financial Reporting Standards. It can result in misleading information and poor managerial decisions. Okay? Why? No? Later on, we will have a preview, no? Why absorption costing is not a good tool for managerial decisions. So if that is the case, no, variable costing is more appropriate tool for the managerial decisions. Okay? And again, no, a review is another is a review of what is the distinction between your period and product cost. Your period cost is charged against current revenue during a time period, regardless of the difference between production and sales volume. Whereas with your product cost, no, this is whereas with your product cost, it is included in the computation of your product cost. That is a portion between the sold and unsold units. So in here, your product cost has a bearing on the sold and unsold units. Whereas with the period cost, it has no regard it has no regard pertaining to the production and the sales volume. For the period cost, again, no, it does not form part of the cost of the inventory. No, your cost of inventory is also your product cost. While for your product cost, it is your inventoriable cost. The portion of the cost that has been allocated to the unsold units become part of the cost of inventory. While for the sold units, it becomes part of your cost of goods sold. Okay. For the period cost, no, it reduces income for the current period by its full amount. Whereas with product cost, it reduces the current income by the portion allocated only to the sold units. And the portion allocated to the unsold units will be treated as an asset, being part of your cost of inventory or your inventory account. Okay? after we've learned the distinction between the period and product cost, now a review again of your period and product cost. So, what is the difference between the absorption and variable costing? Now, as to the income, no, your variable and absorption costing methods of accounting for fixed manufacturing overhead result in different levels of net income in most cases. The differences are timing difference pertaining when to recognize the fixed manufacturing overhead as an expense. In variable costing, it is expense during the period when the fixed overhead is incurred. Okay? Please do remember that, no? It is expense, no? Your fixed overhead is expense when incurred. While in absorption costing, it is expense in the period when the units to which such fixed overhead has been related to sold units. Okay? You only recognize the portion of that fixed overhead when the units are sold. Okay, so what are the arguments for the use of variable costing? No, if you happen, so this is your first time to hear variable costing, no, in terms of using it in management purposes, right? So in here, no, your variable costing reports are much simpler and more understandable in a way that is segregated as to the variable cost and fixed cost. And the data needed for break-even, no, and cost volume profit analysis or CVP analysis are readily available. If you can recall our discussion with CVP analysis and break-even, well, we have there a discussion about your contribution margin approach income statement. No, it is much related to the variable costing topic that we have right now. Okay. And then for the variable costing also, the problems involved in allocating fixed costs are eliminated because we have already segregated your fixed cost and your variable cost. And again, the variable costing is more compatible with the standard cost accounting system. Now, when we go through the topic standard costing, you'll know what I mean. Okay? Next, also, your variable costing reports provide useful information for pricing decisions. Since you have already a good grasp of what are the costs under variable cost, no, you can now use this information for your pricing decisions. And also, there are some other decision-making problems encountered by management pertaining to your variable costing. Okay? Particularly on relevant costing or what we call differential costing, no? Okay? So what now are the arguments against variable costing? So these are the cons. Okay. So the cons here is that the segregation of cost into fixed and variable costs might be difficult, particularly in the case of mixed cost. Remember, you have already tried separating the mixed cost into variable and fixed cost through the use of high-low method and least square regression method, right? So you already encountered the difficulty in doing that cost estimation. Okay. The second con here is that the matching principle is violated by using variable costing, which excludes fixed overhead from product cost and charges the same to period cost regardless of the production and sales. In here, we violated the matching principle because we already charge your fixed overhead cost to period cost outright. No, there is no regard to the production and sales of units. Whereas with absorption, right, the fixed overhead is part of your product cost. So when you sell the units, automatically the whole product cost will be now expense as part of your cost of goods sold. Whereas with variable costing, regardless of the sales and production, your fixed overhead will be outrightly be recognized as an expense in your period cost or as part of your period cost. Okay. Another con or cons is that with variable costing, Inventory costs and other related accounts such as working capital, current ratio, acid test ratio are understated because of the exclusion of fixed overhead in the computation of product cost. Again, because the fixed overhead is part of your period cost, and it will have an effect in the computation of your financial ratios because the amounts pertaining to the inventory are understated. Okay, so next, do take note that the differences in income from alternate methods is small when your fixed overhead is a small percentage of your total manufacturing cost. Second, also, is that if your inventory levels are low, meaning to say these are in amount that is not very significant. Okay, given let's say for example is that you are employing the just-in-time strategy of managing your inventory, meaning to say you minimize your inventory level. So in here, your inventory account balances would be probably below. Okay, so there will only be a slight difference in your income pertaining to the variable versus the absorption costing. And lastly, no, another factor is that when your inventory turnover is rapid, meaning to say you have a good movement of inventory, no. Let's say for example you have a fast moving inventory, whereas your level of inventory balance would only be small, and hence it will only have a slight difference in your income on both the methods. Okay, again, for your absorption costing, no, your product costs will include your direct material, your direct labor, your variable overhead, and fixed overhead. Again, a review. Again, your product costs, these are your inventoriable costs. Now, any cost that is incurred in relation to the manufacture of your product or service. For the product, what are the inclusions under this type? No, one, we have your direct material. Again, your direct material pertains to the traceable materials that is used in manufacturing your product. Okay, or anything that can be seen by the naked eye, no, or you can trace, no, in the product with regard to your raw materials. Okay, and then the next we have again your direct labor. Your direct labor, these are the costs really these are your costs in relation to the salaries paid to your um, workers directly manufacturing the product. Let's say for example in here we are paying the salaries of your assembly workers. Okay, so we have next part of your product cost under absorption costing is your overheads. So we have to your variable and your fixed overhead. No, if you can recall again, your cost behavior pertain to variable overhead. The variable overhead cost, just like with any variable cost, it varies with regard to your activity or cost driver. It is constant in unit cost. While for your fixed overhead, it is constant in total, and it is inversely related to your cost driver or activity. If your activity or cost driver increases, definitely your unit cost pertaining to your fixed overhead is what? Decreasing. And vice versa, no? Let's say for example, your activity driver or your cost driver activity decreases, your unit cost pertaining to your fixed overhead will increase. Okay? So now we go again to your variable costing. So in here, um, your product cost here will now only include your direct material, your direct labor, and your variable overhead. So what happens to your fixed overhead? Your fixed overhead, as mentioned earlier, will now be part of your period expense and this is not now part of your product cost. Okay. To illustrate, we have here your summary product cost data. So we have the direct materials amounting to $4 per unit, your direct labor amounting to $8 per unit, and your overhead that is segregated into variable overhead and fixed overhead per year. Now, your variable overhead amounts to $180,000. For your fixed overhead cost, it amounts to $600,000. And your total overhead, no, your variable and fixed overhead will now be $780,000. And the expected units to be produced per year is 60,000 units. So, for us to compute the variable overhead cost per unit, we have here your 180,000 variable overhead cost. We divide it by your units produced, no? The expected units produced of 60,000 units in order to get the variable overhead cost per unit of $3 per unit. For your fixed overhead cost per unit, it is computed as your total fixed overhead cost of $600,000 divided by your expected units produced by 60,000 units, and it will give us a unit cost or your fixed overhead cost per unit of $10 per unit. So in summary, we have here the breakdown of your per unit or your unit cost. Under absorption costing, please do remember that all the elements under the product cost is part of your product cost. No, what are these elements? No, we have your direct material, your direct labor, and the breakdown of your overhead costs pertaining to your variable overhead cost and fixed overhead cost. So in here, we have a $4 per unit for your direct materials, $8 per unit for your direct labor cost per unit, $3 for your variable overhead cost per unit, and $10 for your fixed overhead cost per unit. It will give us a product cost of $25. While for your variable costing, no, the same goes for your absorption costing. We included your direct material, your direct labor, and variable overhead, but we excluded the fixed overhead cost per unit of $10, giving us the total product cost per unit of $15. $15. Okay? So there's a difference of $10. The difference of $10 pertains to your fixed overhead cost per unit that is not included in the variable costing. So where it will go? It will go to your period cost. Okay? Okay, another example in here. A manufacturer reports the following data. So we have your direct materials of $6 per unit, your direct labor of $14 per unit, and your overhead cost. No, we have a breakdown here of your variable overhead amounting to $220,000 per unit, and your fixed overhead cost of $680,000 per year. So we have here your unit cost, no, pertaining to your variable overhead, $11 per unit, and $34 per unit pertaining to your fixed overhead. And the expected units produced is 20,000 units. So what are the requirement? No, number one, we need to compute the total product cost per unit under absorption costing, and number two, compute the total product cost per unit under variable costing. The first requirement is to compute for the product cost. So remember that your product cost under absorption costing includes your direct material, direct labor, variable overhead, and fixed overhead. So in here, we just only add all the related elements pertaining to your product. So it is $6 for your direct material, $14 for your direct labor, $11 for your variable overhead, and $34 for your fixed overhead cost. So that gives us a total of $65 per unit under the absorption costing. Okay, under now your variable costing, your product cost would only include the related variable cost, right? So what are the variable costs under product cost? It is your direct material amounting to $6, your direct labor of $14 per unit, and your variable overhead cost of $11. So when we get the sum of all these three items, it will give us your product cost of $31 per unit under variable costing. While for the fixed overhead cost of, the fixed overhead cost per unit of $34, it will now be part of your period cost or period expenses, and it will not be part of your product cost. If it is part of your product cost, it will be under absorption costing. Okay? So here is an problem relating to reference 1 problem. Okay? So if you can remember, so your sales here is 60,000 units multiply by your selling price of $40. And your cost of goods sold is computed as your 60,000 units that you sold with a product cost of $25 under absorption costing. Okay, if you can recall, we have your computation here. Okay, so your product cost under absorption cost, it includes again your direct material, direct labor, your variable overhead cost per unit of $3, and fixed overhead cost per unit of $10 that give us $25 per unit. And when we deduct your cost of goods sold from your sales, it will give us your gross margin of $900. So the amounts here is your selling and administrative expense. It was just given in this instance. Okay, so we have your $200,000 as your fixed cost pertaining to your selling and administrative expense, and your variable cost of 60,000 units that you sold multiplied by the fixed selling and administrative expenses per unit. That gives us a total selling and administrative expenses of $320,000. So when we deduct it from your gross margin, it will give us a net income of $580,000. Okay. Now under your variable costing, no, um, we still begin with your sales amount, right? So it's your 60,000 units that you sold multiplied by your selling price of $40 per unit. It will give us a sales value of 2.4 million, just like with the sales under absorption costing. The difference that under variable costing, instead of deducting your cost of goods sold under absorption costing, we will deduct your variable expenses, and your variable expenses includes your variable production cost and also your variable selling and administrative expenses. So in here, how do we get your variable production cost? Or it is what your units that you sold, okay, multiply by the um, product cost under your variable costing. So how did we get that? So we'll go back to this slide. So we have here your product cost under variable costing of $15. It only includes your direct material, direct labor, and your variable overhead cost per unit. So that will give us a total of $15 as your product cost under variable costing. So that's why your computation here, 60,000 again, units, multiplied by $15 per unit as your product cost under variable costing. Are we done? Not yet. We need to add also under your variable expenses your variable selling and administrative expenses. Please do remember that in the previous slide, it is already given here. No, the 60,000 units that you sold multiply by your variable selling and administrative expenses per unit. So that gives us a total amount of $120,000. So when we add these two variable expenses, it will give us your total variable expenses of $1,020,000. So when we deduct this amount from your sales, it will give us your contribution margin of $1,380,000. So do you remember it's the same format with your contribution margin approach income statement from our last discussion with CVP analysis. So after we now get your contribution margin, we will now compute for your total fixed expenses. So please do remember that your fixed expenses also has a breakdown of your fixed overhead and your fixed selling and administrative expenses. Now, for the fixed overhead, no, we go back to the slide, no, relating to problem reference 1, no, it is already given in here, your fixed overhead of $600,000. Okay, it is here. Next, for your fixed selling and administrative expense, it is already given in your previous slide here. Okay, it is what? Your $200,000 as part of your selling and administrative expenses under your absorption costing. So here's the amount. So when we add the two amounts, it will give us your total fixed expenses of $800,000, which will give us your net income of $580,000. Okay? Oh, what did you notice with our computation? No, under your absorption costing, we follow the traditional way. No, we deduct your cost of goods sold from sales. We got your gross margin, and we deduct your selling and administrative expenses from your gross margin in order to get the net income. While for variable costing, we compute for your sales and we deduct the total variable expense to get your contribution margin minus your total fixed expense in order to get the net income. Okay, but still they have the same net income. Again, under the premise that your units sold and units produced are the same. Okay, so in here, we can see that the income under variable costing is also 580,000. This is because the number of units produced are equal to the number of units sold, as I've mentioned earlier. A performance report that excludes fixed expense and net income is a contribution margin report. Its bottom line is contribution margin. So, okay, next. So in getting the total cost or expense under absorption and variable costing, they will have the same bottom figures, no, in terms of getting the total cost or expense under absorption costing. Okay, assuming that we don't have any beginning balances pertaining to your finished goods inventory, your direct material, direct labor, your manufacturing overhead and fixed manufacturing overhead will have a total of 1.5 million. That pertains to your cost of goods manufactured, and then we deduct your EWIP, will have your cost of goods sold amounting to 1.5 million. Now, under variable costing, no, your cost of goods manufactured includes your direct material, direct labor, variable manufacturing overhead, and we don't add here your fixed manufacturing overhead. So when we add the three, it will give us your cost of goods available for sale. No? Whereas under your absorption costing, it's already 1.5 million. So where do we now see your fixed manufacturing overhead? It is under your period cost. Okay, it is not part of your cost of goods sold. Okay, remember, under variable costing, your fixed overhead cost is part of your period cost. So it will be included here, not included in your cost of goods sold. No, this is your product cost. So that's why, again, your total expense will still be the same under both the costing methods. Okay, so under absorption it's 1.5, under variable costing it is 1.5. Only difference between the two is the details, no, pertaining to your bottom figure. Okay, so next, what if your units produced exceeds your units sold? So what happens is, so in this two scenario, we have your income statement under your absorption costing and your income statement under your variable costing. As you can see, your sales here are both at 1.6 million. The difference is that your under absorption costing, we have a total of 1 million. Now, to the variable costing, no, the income statement here is that your variable expenses has a breakdown of your production cost amounting to 600,000 and your selling and administrative expenses of $80,000. So we have a total here of $680,000, and it will give you a contribution margin of $920,000. Now, for the income statement for absorption costing, we have your gross margin of $600,000. And your selling and administrative expenses is equal to $280,000 that will be deducted from your gross margin in order to come up with your net income. For your variable costing income statement, we will deduct your fixed expenses. Now we have the breakdown of your expenses to fixed overhead of 600,000 and fixed selling and administrative expense of 200,000, which will give us a total fixed cost of $800,000, and it will be deducted from your contribution margin in order to get your net income of 120,000. So what happened? Why the net income under each costing methods are different? So as you can see, since your units produced exceeds your units sold, we can assume under absorption costing that the portion of your fixed overhead cost pertaining to your unsold goods was now part of your or is now part of your inventory. Okay, so what happened if it is part of your inventory? Your inventory will be um, overstated, and what will happen to your cost of goods sold? It will be understated. And what will happen to your net income? It will be overstated. So how much is the overstatement? It is your fixed overhead cost that is now part of your inventory. For your variable costing, okay, regardless of your unit sold or produced, your fixed overhead cost in total will be fully deducted from your contribution margin. That is why your net income here is $120,000 only. Fixed overhead is fully deductible from your contribution margin. Okay? So, in the absorption costing, your fixed overhead only pertains to a portion of that full amount. So why? Remember that your units produced exceed by your units sold. Your units sold is only 40,000, where your units produced is um, 60,000. Okay? So where did the 20,000 difference go? So it's now again part of your inventory, right? So in here we have your 20,000 difference multiplied by your $10 per unit. It will give us an amount of $200,000. So that is why there is a difference of 200,000 in the net income under each product costing methods. Okay? Okay, under variable costing, no, your net income is only $120,000. Whereas with your absorption costing, it will give you a net income of $320,000. Okay? So here's the breakdown of how did we compute for the cost of goods sold, your ending inventory, and your total expense. Okay? Okay, to visualize it better, no, we have here the breakdown of computing the cost of goods sold and your ending inventory under absorption costing. Okay, please do remember that we have a total units produced of 60,000 units, right? And we only sold a portion of that, that is 40,000. That's why your computation here is the 40,000 units sold for each element of the product cost. Direct material, no? Your direct labor, your variable overhead, and fixed overhead. So the units here are all 40,000, and we only multiply it by your unit cost per element. Okay? Same goes for your ending inventory, that is 20,000. No? Each element has a cost assigned pertaining to each element of the product cost. Whereas with your variable costing, uh, the computation is same for your direct material, direct labor, and variable overhead. The difference is that your fixed overhead, no, we didn't put any amount under your cost of goods sold and ending inventory. Why? Because the full amount pertaining to the incurrence of your fixed overhead cost now goes to the period cost. It is now outright expense and not part of your product cost. That's why it will give us a difference of 200,000. Whereas with your absorption costing, the 600,000 here under variable costing is not part of your period cost under absorption costing, but it should be allocated to your cost of goods sold and to your ending inventory pertaining to your units sold and unsold respectively. Okay? Next scenario, what if your units produced is less than your units sold? Okay. Please do remember that we use again your the reference one problem, no, wherein we have produced a 60,000 units, okay, and then in this scenario we sold 80,000 units. Okay, so what will happen in this case? No, your units sold, no, no, if you can recall, in 2016 we have an excess of 20,000. In this case, no, the 20,000 together with your production of 60,000 units were sold completely in this year. No, we carried over the inventory from last year and we sold it in full together with your total production. However, your production is less than your units sold. Okay? In this case, your units sold is 80,000 and again, your units produced is 60,000. So there is a 20,000 difference in terms of units. So under absorption costing, now your income statement here, it will give us a total net income of $840,000. While for your variable costing, it will give us a net income of $1,040,000. So what happened? No, in this case, your direct material, your direct labor, your variable overhead, and fixed overhead under absorption costing are all recognized in cost of goods sold. Okay, the amounts no pertaining to your 80,000 units for your direct material, 80,000 units for your direct labor, and 80,000 units for the overhead is multiplied by the unit cost for each element. And for your fixed overhead, no, the fixed overhead that you have from the beginning inventory is now classified as your cost of goods sold since the beginning inventory and the current production were all sold, right? So it is now part of your cost of goods sold, giving us a total cost of 2 million under absorption costing. While for your variable costing, in here, no, still your direct material, your direct labor, and variable overhead are all multiplied by their respective cost per unit of each element. Okay? And what happened to your fixed overhead? Of course, it is not in full of 80,000 units. Only the portion pertaining to your units produced. Because again, the 20,000 units that we have in excess from the previous year was already recognized as part of your period cost. Okay? In this period, in 2017, no, we only recognize the incurred fixed overhead cost for the current period. No, regardless of your sales and production, the incurrence of that said expense will be outrightly expense. Okay? So we have here your total cost of 1.8 million. So there is a difference of again 200,000. But the difference now is that your absorption costing now has a lower net income due to high total cost. Whereas with your variable costing, you have a lower cost, no, giving you a higher income of $200,000. So in this case, guys, the units produced is more than the units sold. Okay, so we have here direct materials per unit of $6 per unit, your direct labor per unit of $11, variable overhead cost of $3 per unit, your fixed overhead for the year, it is $680,000 per the year, for $680,000, your sales price of $80 per unit, your variable selling and administrative cost per unit of $2, and your fixed selling and administrative cost per year of $112,000. So the requirement here is that we need to prepare an income statement for the year using your absorption costing. So before we can prepare your income statement under absorption costing, we need first to compute for the product cost per unit, no, under absorption costing. So remember that under absorption costing, no, we add all the variable cost and fixed cost. Okay, so in the variable cost, we add your direct materials per unit, your direct labor per unit, your variable overhead per unit, and your fixed overhead per unit. In this case, since it was given here that your fixed overhead cost for the year is $680,000, we divided it by your units produced of 20,000, giving us the fixed overhead cost per unit of $34. So adding all this uh, cost unit cost per element of the product cost, it will give us the product cost per unit of $54. And this amount will help us compute the cost of goods sold. Okay. So for the income statement under absorption costing, we have your sales of 14,000 units multiplied by your selling price of $80 per unit. It will give us the total sales amount of $1,120,000. While for your cost of goods sold under absorption costing, remember, it is your product cost wherein we include all the variable cost and the fixed overhead cost pertaining to the production. Diba, diba? We have computed in the previous slide that it is to $54 per unit. So that is 14,000 units multiplied by your product cost under absorption costing of $54 per unit. It will give us your total cost of goods sold of $756,000. And we will deduct that amount from your sales, giving us a gross margin of $364,000. Okay, so now we deduct your selling, general, and administrative expenses. That has a breakdown of your variable and fixed component. Now, as to the variable, selling, and administrative expense, we have already your um, variable selling and administrative cost per unit of $2 per unit. We only need to multiply it to the units we sold. Okay, so that is 14,000 times 2. It will give us your variable selling and administrative expenses of 28,000. For the fixed component, it was already given in the table. It is here, $112,000, giving us your total selling, general, and administrative expenses of $140,000, and we deduct it now to your gross margin, giving us a net income of $224,000. Okay? So for our next requirement, we need to prepare an income statement for the year using variable costing. But before we can prepare the income statement, we need first to compute for the product cost per unit using variable costing. Just like with absorption costing, no, we already computed the product cost per unit. We will not only include here your fixed overhead cost per unit under variable costing, making our product cost per unit only of $20 per unit. Okay? So now we now prepare the income statement. So in here, we have your sales amount of 1,120,000. It has the same computation with absorption costing. And now we deduct your variable cost. Your variable cost here has two components. One pertains to your production cost, and the next one pertains to your selling and administrative expenses. For the production cost, we multiply the units produced by the product cost per unit under variable costing of $20 per unit. We did not include the fixed overhead cost per unit. Okay, giving us your total variable production cost of $280,000. For your variable selling and administrative expense, it is 14,000 units multiplied by your variable selling and administrative expense per unit of $2, giving us an amount of $28,000. And when we sum the amounts here, it will give us a total of $308,000 pertaining to your total variable cost. And when we deduct this amount from your sales, it will give us your contribution margin of $812,000. And now we go to the total fixed expenses, which has a two component. No, first is your overhead cost, no, and the second is your selling and administrative expenses. In this case, your overhead cost is $680,000. It's already given in the this table. Okay. So remember, under variable costing, your fixed overhead cost will be recognized in full, no, in the period cost, regardless of your sales or production. Okay? And then for your selling and administrative expense, it's all same with your overhead cost. It is already given in this problem. It is 112,000. And when we add the two, it will give us a total fixed expense of 792,000. And when we deduct the 792,000 as your fixed expense from your contribution margin, it will give us a net income of $20,000. Okay? So when we compare the income statement of the variable costing to the absorption costing, definitely the net income is higher under absorption costing. Okay? Why? Why? Because your units produced is higher than your units sold. The fixed overhead cost that is incurred in the current period is fully deductible from your sales, right? So under absorption costing, it will have a lower net income as compared to your absorption costing, which has a higher net income. Why? Because your fixed overhead cost is part of your inventory. And if your inventory is overstated, your cost of goods sold will be understated, making your net income overstated. Okay? So, if the problem is asking for the difference of the net income between absorption costing and variable costing, how do we get the value? So please do remember the excess of inventory in terms of units sold and units produced. In this case, since the units produced is in excess of the units sold, we get the difference of 6,000. How did we get that? It's the units produced of 20,000 less your units sold of 14,000, giving us a 6,000 in excess of inventory. And related information for us to get the difference of income is what? It's your fixed overhead cost per unit. In this case, we already have the figure of $34 per unit. And that amount will now be multiplied to your in excess unit of 6,000, giving us a value of 204,000 as the difference between the net income under absorption and variable costing. Please do remember that the factors that will be considered in the difference of the net income between the two methods is what? It's your in excess of unit in terms of units sold and produced, and your fixed overhead cost per unit. So that's where the difference is coming from. Okay? Okay. Please do remember that income under variable costing is restated to that under absorption costing utilizing the following formula. So you can use this formula, guys. Okay. On how we can convert the variable costing income to absorption costing. If the problem is asking for the income under absorption costing, and the only information contained in the problem is income under variable costing, how do we now convert the amount going to absorption costing. We only what? Add your fixed overhead cost in ending inventory, and we deduct your fixed overhead cost in the beginning inventory in order for us to get the income under absorption costing. Okay? Okay, using the information that we obtained from the first problem that we got, remember that we have three scenario. In 2015, the units sold and produced is the same. For 2016, the units produced exceeds your units sold. Whereas in 2017, your units produced is less than your units sold. So what happens in 2015? Since there is no difference between the units sold and produced, so there is no difference in the net income under both the variable costing and absorption costing. For 2016, since we have an excess of units produced than sold, so meaning to say the fixed overhead cost that pertains to your ending inventory should be added to your variable costing income in order to give us the net income under absorption costing. Okay? And then in 2017, we have an excess of your units sold versus units produced. It is the inverse of 2016. So what happened? So we didn't have any more deferred cost pertaining to your fixed overhead at the ending inventory. Okay, since there is no ending inventory. While in your beginning inventory, no, since we have a unit sold of 80,000 and we only have the units produced of 60,000, we can assume that the 20,000 is the remaining 20,000 there comes from your beginning inventory. So we need to work it backwards, no? We deduct the fixed overhead cost recognized from the beginning inventory from your variable costing income in order to give us your net income under absorption costing of $840,000. Okay? So in here, we can say in 2016, to restate the variable costing income to absorption costing income for 2016, we must add back the fixed overhead cost deferred in ending inventory. And in 2017, similarly, to restate variable costing income to absorption costing income for 2017, we must deduct the fixed overhead cost recognized from the beginning inventory, which was already incurred in 2016 but expensed in the 2017 cost of goods sold when the inventory was sold. Okay? So next slide, no, we are still relating to the first problem that we have. Now, what would happen if Ice Age Manager decided to produce 100,000 units instead of the initial units that we have, that is 60,000 units? The 40,000 extra units would be stored in inventory, and the total production cost per unit is $4,000 less. So in this table, this is the values that we have if we are to produce 60,000 units. So we have here direct material cost of $4 per unit, your direct labor cost of $8 per unit, your variable overhead of $3 per unit, giving us your total variable cost of $15 per unit, and then we add your fixed overhead of $10 per unit. So in here, we still use the figure of 60,000. So we got the fixed overhead by dividing 600,000 by 60,000 is giving us that amount, no? $10 per unit. And we have your total production cost or total product cost per unit of $25. So in this statement, it was mentioned here that your total production cost per unit will be $4 less. So how did we compute that amount? Okay. So in here, when we produce 100,000 units, we have the same variable cost per unit of $15 per unit, no? The same with the previous slide, right? And then we have now your fixed overhead. No, how do we compute now for its cost or for its unit cost? It is 600,000 divided by 100,000 units instead of 60,000 units. That will give us a unit cost of $6 per unit, giving us a total production cost of $21 per unit. So in here, we have a total product cost per unit of $25 per unit. And using 100,000 units as your units produced, it now decreased to $21 per unit, having a difference of $4 per unit. Okay? So in here, under absorption costing, if we have or we still use the figures in the first problem, no, wherein your units produced is equal to your units sold, we'll have a net income of $580,000. Now, please take note that income under absorption costing is what? $240,000 greater if management produces 40,000 more units than necessary and builds up ending inventory. Why so? Because your excess of 40,000 units will now be part of your inventory. In what value? So that is 40,000 units multiplied by your um, fixed overhead cost per unit of $6 per unit. Right? So, that is 40,000 units or more units multiplied by your fixed overhead cost per unit of $6, giving us a total value of $240,000. Okay? So, we have here your income statement under absorption costing wherein your units produced is 100,000 units. And then we have 60,000 units sold. So, we have now a net income of $820,000. So, it is what? Higher of or higher by $240,000 as compared to your income statement wherein your units produced is 60,000, no? The same wherein your units produced is equal to your units sold which is 60,000 units. And in what difference? It is $240,000. Okay? This only shows that a manager can report increased income merely by producing more and disregarding whether the excess units can be sold or not. So that is one of the strategy. In order for us to get a higher income, we produce more inventory, making our cost of goods sold smaller. Thus, the net income is now higher. Okay? So that is one of the strategy that you can employ. No, you produce more, and then you will have a good net income. However, there will be some issues for the inventory management. Why? Because we are piling up um, a huge volume or amount of inventory that will entail many costs, right? If you remember your inventory management in cost accounting, we will what? Uh, incur carrying cost, okay, ordering cost, okay. Next, what if we have to we have to prepare the income statement under variable costing. Your net income will still be the same regardless if you produce more or you produce less, no? Okay, that is in variable costing. So under variable costing, even if I produce more unit, it doesn't affect the reported net income. I actually have to sell more units to increase my net income. Okay? I think that is elementary to you. No, the more that you sell, of course, you will have more income. No, but again, if you produce more or less, it does not again affect the net income. No, under variable costing. In the absorption costing, it is a different case, right? As I've mentioned earlier. Okay? In here again, in order to have an income, in order to have an increased income under absorption costing, you have to produce more. Okay. Okay. Uh, so here is a summary of the effects on operating income in two different scenario. Okay. When your production is higher than your sales, your ending inventory will automatically increase. Why? You only have a small amount of sales, and of course there will be a remaining inventory. Hence your ending inventory will increase. And under this scenario, okay, your under absorption costing, some fixed manufacturing costs are included in ending inventory, reducing your cost of goods sold. If you have an overstatement in ending inventory, your cost of goods sold will be understated or reduced. Okay? Under variable costing, all fixed costs of the current period are expense. No fixed costs are included in ending inventory. Okay? I think that is just the same if you have more units sold than units produced. And please take note that under this scenario, again, if you have a higher production than your sales, your operating income is higher under absorption costing. Taking into account that taking into account that your fixed overhead cost is fully expense in the current period. Okay, making your absorption costing having a higher net income. Okay, and what if when the production is less than your sales? So what will happen to your ending inventory? It will decrease. Now, under absorption costing, fixed manufacturing costs included in beginning inventory are expense, thus increasing your cost of goods sold. However, it will only decrease your net income under absorption costing. Then under variable costing, all fixed costs of the current period are expense. No fixed costs are included in the ending inventory. This is just the same with in this previous scenario, right? And please do note that operating income is higher under variable costing. Okay? We have a higher operating income in variable costing is because we only incur lower fixed overhead costs in relation to the production. No? In here, we have a lesser production than your sales. Okay? Next. So in here, we have to set prices. As business managers, if we have an idea of what our product costs, we can now set the price. No? Although many factors impact pricing, cost is a crucial factor. That is why cost accounting and your strategic cost management is very important, particularly for business management. You need to know your cost in order to provide your price, or in order for us to provide the price to our customer. And it should be noted that when you set prices, the expenses should be covered, and it shall give you a good amount of profit in the long run. Okay, next, absorption cost information is useful because it reflects the full cost that sales must exceed for the company to be profitable. Okay, if you have your absorption costing or absorption cost information, you have a full picture of your cost or full cost that will serve as the base of your of setting the price. And over the long run, price must be high enough to cover all costs. So meaning to say, no, not only the production but also your selling, general, and administrative expenses. Okay. So what are the steps in order for us to determine the selling price? No, one, no, we have to determine the product cost per unit using absorption costing. No, it is better that we use absorption costing rather than the variable costing because again, it includes the full cost. And our main target here, again, is to cover the cost, plus we need to have a good profit. Okay. Then step 2, we need to determine the target markup on product cost per unit, and maybe in terms of percentage over the cost, no? And that's the markup, no? And then we have step 3, we have to add the target market to the product cost to find the target selling price. Of course, if you have the markup, you need to add that markup to the product cost to find the, or to target, to find the target selling price. So here's an example. ISH will use absorption costing to determine a target selling price. So in here, we have to determine the selling price with absorption costing. So step 1, we need to get the absorption cost per unit. And we have already computed this one. It is valued at $25 per unit. Or what we call the uh, full or absorption cost. And then step 2, we have to target markup per unit. In here, it is stated that to we need to compute your markup by multiplying 60% by your absorption cost of $25, giving us a target markup of $15. And then we add the target markup to the absorption cost per unit. We now go to step 3. No, we are getting your target selling price per unit. In this case, no, we have an absorption cost per unit of $25 and target markup per unit of $15. It will give us the target selling price per unit of $40 per unit. Okay. So again, no, we have to start with the product. In this example, the in the table, we choose a markup of 60% of cost. So the target selling price is what? $40 per unit. Then management needs to determine a target markup. If in case they do not agree with the recommendation that you have, no, in terms of having a markup on your product. Okay. So in terms of controlling costs, now managers are responsible for controlling, or for their controllable cost. No, a cost is controllable if a manager can determine or affect the amount incurred. No, there will be some time, no, the manager can hold some activity, no, or expense, or they can induce some activity in order to incur expenses, no, that will benefit the company, no. Actually, the manager is very powerful in terms of controlling the cost. Okay. So the example here is that variable production costs are controllable by production supervisor, and fixed costs are controllable by higher level manager. So most likely, your fixed cost, since it is constant all throughout the period, it should be managed very well. No, particularly by higher level manager. It can be director, it can be the principal, it can be the executive director, or management officers of the company. Okay, and of course, if there is a controllable cost, we have uncontrollable costs that are not within the manager's influence. It can include your production capacity. Okay, since your production capacity depends on the orders or the demands of the customer, it will be driven by that factor or function. Okay, so do we have any variable costing for service firm? The answer is yes. No, variable costing also applies to service companies, not only to manufacturing or product or trading companies. And there should be a focus on variable cost that is useful in managerial decision. So since your variable cost is more controllable, no, it is very useful in the managerial decisions. So of course, there will be a special order pricing that may be used to deeply discount a service, even though discounted price is greater than variable cost, but the sale will increase contribution margin and net income.
So for our first problem, no, pertaining to setting the prices, no, part one, a manufacturer's absorption cost per unit is $60. Compute the target selling price per unit if a 30% markup is targeted. So in here we have a absorption cost per unit of $60, And according to the company, they want to set the markup a 30% based on cost. Okay, so in here we have a 30% markup, and then we multiply it by the absorption cost per unit. We'll get a target markup per unit of $18. So we add the two, and we will get your target selling price per unit of $78. Okay. Okay, and another type of problem is where if we are to accept or reject some special projects, right? So in this case, no, a hotel rents its 200 luxury suites at a rate of $500 per night per suite. The hotel's cost per night is $400, consisting of the following breakdown. For your variable cost, it is $160. For your fixed cost allocated, it's $240. And when we add the two, we have the total cost per night per room. The hotel's manager has received an offer to reserve a block of 40 suites of $250 per suite per night during the hotel's off-season, when it has many available suites. Determine whether the offer should be accepted or rejected. So in this case, class, since it was mentioned in the problem, when it has many available suites, meaning the company has an excess capacity. If that is the case, if you have any excess capacity, as long as the price or the incremental sales or price is above your variable cost, then definitely you can accept the um, special project. Okay? When evaluating a special offer, the allocated fixed cost should be ignored. So in this case, no, regardless of the decision if you accept or reject, since both the fixed costs will be incurred, so we are indifferent on that situation. Since the hotel is not at full capacity, meaning at excess capacity, the revenue from the special offer must be simply be greater than its variable cost, as mentioned earlier. Because the offer price is $250 per suite is greater than the variable cost at $160 per suite, the offer should be accepted. Okay. However, if it is at full capacity, definitely you will reject the offer. Okay. This special offer has a contribution margin of $90 per suite, coming from $250 revenue or selling price less your variable cost. Net income will be higher by 3,600, or there will be an increment of net income amounting to 3,600 coming from the 40 suites multiply by your contribution margin of $90 per suite. Okay. And then this is the computation for the incremental contribution. So in here, had the hotel been at full capacity, the offer would have been rejected. Okay. So guys, please take note that over the long run, price must be enough to cover all the cost, including the variable cost and fixed cost, and still provide an acceptable return to the owners. And then over the short run, fixed production costs such as the cost to maintain plant capacity do not change with changes in production levels. With excess capacity, increases in production level would increase variable production costs but not fixed costs. Okay? So unless it is at full capacity, of course, there will be an increase also with your fixed costs, since we have a what we call relevant range, the assumption of cost, right? And then we have here, while managers try to maintain the long run price on existing orders, which covers all production cost, managers should accept special orders provided, again, that the special order price exceeds variable cost. Otherwise, no, kung if the special price is below or the special order price below the variable cost, you will definitely reject the offer because you are accepting a project or special project at a loss. Okay, so we have here your another problem, wherein using variable costing in pricing special order. So we have here a another problem wherein should the company accept a special order for 1,000 pairs of skates at an offer price of $22 per pair. So in here we have two cases wherein we should reject the special order or accept the special offer or special order. So we have here your incremental sales of 1,000 multiplied by $22 dollars being the offer price. So it gives us an incremental sales of $22,000. And then we have the incremental cost. Now we have two components. First is the variable production cost of 15,000. We compute it as 1,000 uh, pairs of skates multiplied by the variable production cost per unit of $15, which gives us a total of 15,000. For the variable selling expense, it's 1,000 multiplied by $2, so it gives us a total of $2,000. So the total of the two components is 17,000. It is your incremental cost or the incremental variable cost, which gives us the net amount of 5,000 being the incremental income. We just only leave the information from our first problem wherein we have your total product cost per unit of $25. So in this case, our again, no, if we are to accept or reject special orders, no, particularly when we are doing or making a decision or when we are facing a decision making, please remember that your variable cost, no, or your variable production cost would really matter. So in this case, we have our variable production cost of $15 coming from the direct material cost per unit of $4, direct labor cost per unit of $8, and your variable overhead cost per unit of $3. Okay, $3. So in this case, no, since your order price is higher, no, your 22 order price is higher than your variable production cost, no, the order should be accepted because you will have an incremental income of $7, uh, $7 per unit. Okay, just like with our computation here, you will earn a incremental income of $5,000 as long as this 1,000 pairs is not at full capacity or is not offered at full capacity, meaning to say it is offered at an excess capacity. Hence, it should be accepted. Okay?